digital archive afterwards. The first hour is publicly streamed, and then we reserve the last 30 minutes for a more private Q&A with the cohort. Um, Let me see. I was supposed to have slides, but I did not pull those up. So I'm going to ignore the slides today and we will introduce our panelists. First up, I've got Sammy DeTwani from Life Science Angels. We'll give you a chance to introduce yourself. Then we've got Charles White at Illumina Ventures. And finally, last but not least, Paul Horbelt at RCT Ventures. So, Sammy, could you give us an introduction?
Sure. Excited. Thanks for having me. Always excited to be here. Um, my name is Sami Datwani. I'm the CEO of a protein sequencing company called Prisma Bio. I wear my hat here is with Life Science Angels, where I'm on the board, and I've been Life Science Angel since 2016. My background is, I have a doctorate in chemical biomolecular engineering from Johns Hopkins, and then 25 years working with early stage startups in the Bay Area, mostly focused on microfluidics and applying that for life sciences, for drug discovery applications. And I've dabbled in AI investments, medical device, and therapeutics areas. Great to be here.
Thanks, Sammy. And Charles White at Illumina Ventures.
Yeah, I'm Charles White. I'm a senior associate at Illumina Ventures. My background is a PhD in molecular and cellular biology. Spent some time in strategy consulting, working for life science and pharma companies, and ultimately came to Illumina Ventures about 4 years ago to focus on the tools and diagnostic space. And just briefly, Illumina Ventures is an independent VC firm, so we are not Illumina's corporate VC arm. We have been around since 2016, and we invest in seed and Series A for primarily tools and diagnostics that kind of move the precision health ecosystem forward.
Thanks, Charles. And Paul.
Hey everyone, great to meet you. Great to be here. Thanks, Jim and team. Paul Herbelt, Director of Biotechnologies at RCT. RCT stands for Research Corporation Technologies. And our background actually goes back over 100 years. And before getting into investing and venture-like investing, our original story was around actually tech transfer and licensing. And so we've had a long history of successful products that we've bought the IP for and licensed out. And so essentially we're an evergreen. We're not a fund like a lot of other VCs. And so we bring a little bit of a different perspective, I think, to investing that you'll hear some of today from me. My background's in neuroscience. I got a PhD in neuroscience. I did a postdoc for a while. I was very interested in doing the professor route, but ultimately chose the business route after I'd finished postdoc at Stanford. I did a short stint in management consulting at LEK, working with pharma companies and tools and service companies. Then about 2.5 years ago, I joined RCT, work on the tools and therapeutic side, where we do mainly tools and services and some therapeutics investing.
All right. Thanks, Paul. So let's kick it off. And I was telling the panelists earlier that last week we did the term sheet discussion, and I think we kind of talked about and blew through a bunch of content in a really short period of time. And so, Sammy, maybe you could kick it off with Life Science Angels. You guys invest probably the earliest out of the panelists here. When you guys are looking at investments, can you kind of just talk about the structure of the deals, how those kind of come together? How do you value a company? What do you guys kind of see with the early stage companies?
Yeah, happy to walk through. We are early stage, seed stage. We are not a fund. We're a group of angel investors that if we like a deal, we start our diligence process and go very deep. If we're early in the investment, we'd like to take a board seat so we can be there for the journey. We tend to invest based on expertise that the group can provide to help the company. So we're really there for the journey to be part of it along the way, and we definitely rather see exits than a company go get several rounds of funding and get diluted. I think it's probably a good opportunity to talk about the types of vehicles, that you'll normally see as an investment. That typically come in as safe notes, convertible notes, or priced equity. And SAFE stands for a simple agreement for future equity. It's basically an investment vehicle that, startups like. It's very founder friendly, and you don't set a valuation. So you basically get the rights to invest in the equity. Your money goes towards the equity in the next round. A convertible note is similar, but it comes with usually interest. You have to come up with a valuation of the company, and typically there'll be a valuation cap, there'll be some interest, and usually there's an incentive to bring investors in, and maybe there'll be a discount to the next round. So again, that's a debt vehicle. The third type, and this is the one Life Science Angels likes the most, is equity. We want to price the round and then start the clock. And that really is exciting for investors because there are lots of tax benefits to do with having an exit and where your money can go as long as you start the clock, and the clock's based on having equity and not necessarily a convertible note or some sort of debt. So hopefully
So,
that.
Sammy, why would a company not always just go with price round equity? Well, I mean, if you guys prefer that, why don't they just do that?
You need a lead investor. You need someone that's going to come in and say, we think the value is this. And usually it's early and it's very hard to tell. So sometimes you may have started through an incubator, and they've created a safe vehicle. I think YC does that. A couple other groups do that. Or you may have gone through another process where you've decided, look, I think there's something here, and to get money quickly to grow and do the things you need to do, you basically offer the discount, you offer the interest rate, and so people know that at least they're getting the same and maybe better than putting the money in the bank. So typically it's hard to find someone to lead, and it's hard to price around. Those are difficult, I think, tasks, and they take a lot of work, and someone has to do that work. And not everybody wants to do that. Most people will write a check. At the angel level, they say, yeah, I'll give you, whatever the number is, 50,000, 100,000, and they don't want to bother with all that. So you do want institutional investors, and that's, more of these folks that can help with that. And sometimes the angels do that as well.
Gotcha. Thanks, Sammy.
Yeah, great question.
Charles, you guys kind of come in next at the early VC level. How do you guys kind of see these terms, and where do you kind of come in?
Yeah, I think, we certainly like to come in early with our Illumina Ventures Labs program. We can come in at seed and pre-seed here. And those deals are often in the form of a safer convertible note, which like Sammy talked about. I think, one thing as we get more into institutional VCs and think about heading it to those Series A, is I think institutional investors are maybe a little less excited about uncapped safes or uncapped convertible notes. So we do generally like to have some sort of cap in there, such that there's some idea of what the price will be in the next round. Um, but for Series A and beyond from our main fund, we're doing equity type deals. Those are priced, for tools and diagnostics. We often will lead and help set the price there. Um, but yeah, I think having that a price in there somewhere is really important for this later stage involvement.
And are there like minimum valuations that you guys play with? Does the company have to be at sort of like a certain expected
Yeah,
scale before it's worth your time and energy, or where you kind of think about that?
yeah, I think before we had Illumina Ventures Labs, I would say that like, we don't really want to write checks much smaller than 5 million, which is tough for seed and early stage companies to absorb. But as we've moved into these early stages, we're still looking for companies that are probably raising on the order of a few $1 million. It's hard when you get below that to really you're spread too thin to invest your whole fund like that.
Gotcha. And just curious from Illumina's Ventures perspective, And I'll come back to you, Sammy, on this one actually. Like when you make an investment for your group, you're not taking up, I'm guessing you're not taking up the whole round, you're usually taking up a part of the round. What does your check size look like when you guys put money into a company? Do you have a range?
Yeah, I think, you know, it varies quite a bit depending on the need of the company. I think, we're targeting, you know, um, bigger checks on the later side. I think a lot of VCs will target somewhere between the 10 and 20% owner ownership range at that Series A. Obviously, people are different. And then maybe, depending on expertise in the early space and how much value you feel you can add to the company and the conviction of your team. Um, there's, I think, two approaches to seed investing that we see a lot of. One is putting in a little money to kind of watch the team execute and be involved there, and kind of follow that with the eyes on putting more money in a Series A if things are going well. There's the alternative model where people try to own as much as possible at that early stage, preparing to be diluted through further rounds. So I think it really depends on the company and your team's expertise and which strategy we would pursue there.
Great.
Yeah,
And
I'll
and Paul,
answer.
oh yeah, Sammy, go ahead.
Yeah, I'll answer as well. From take the life science angels perspective. So typically, it's going to be dependent on the type of deal. Med device tools, they tend to be smaller. Therapeutics tend to get a little bit bigger. Our check size typically is in that we have a minimum threshold of like 200,000, and I've seen deals blow up to sort of 2 million range. So we come in pooled with that amount, and depending on the stage and where we are, we will definitely be leading, or we may be coming at the end and following on with an investment, and someone else is leading. We tend to be the folks that do a lot of the homework, and so we have a lot of groups that syndicate with us. So let's say we came in with, 400 or 500K, we very easily can find, 5 or 6 groups that will also join in, and maybe not at the same level, but they'll come in a little bit lower and fill out the round. So that could be like a 2 to 3 million round there.
Okay.
Mhm.
And Paul, how about you guys?
Yeah, so I guess there's a lot to potentially say here. So maybe I'll just break it into kind of three categories here. So like we kind of think about our investments in three ways, right? Like one is the economics of it. The second one is like the control dynamics, and third is really going to be kind of the alignment aspect, and how well aligned we are with investors to entrepreneurs. And so when it comes to economics, we probably invest a little bit later stage than some other VCs typically. And I think, we're kind of unique. We're not a fund, right? So we don't have kind of LPs. We're governed by a board. We are an LP of various funds, and so we can kind of tap into earlier stage investments that way, as an LP. So, generally we'll come in when a company in the tool space or services has a few million in revenue, and with the where the market is now and what we've seen in terms of returns for the tool space, that usually means somewhere around like 5 million, 4 or 5 million in trailing 12 months revenue. And I think we don't need to invest when a company is EBITDA positive, but I think a clear path to being EBITDA positive, or somewhere like 3 to 5 years to exit, given that is kind of where we like to sit. Um, and whether that's a first financing, whether that's a 10th financing, it doesn't matter. I think, that kind of leads into, the control aspect a little bit. But, typically we will invest, because we're not mandated by a fund, we can be flexible with what we invest. It can be anywhere from a couple 100,000 to 5 or 10 million. We have companies that we've invested, 100 million in our portfolio just because of that flexibility, and continue to hold. Yeah, I think a lot of it is when we make a bet, you know, we don't we don't like spray and pray really. Not that no investor would say that they spray and pray probably, but we really don't like to take losses, and so we like to be very involved and pretty active investors. So we'll generally take, if we're leading around or co-leading, we'll take 20+% equity. We own 100% of certain companies. We own, the majority of others. And I think it's kind of been successful for us in the past. I think we're evergreen capital primarily because our as an LP and because of earlier investments we've made in some technologies that continue to provide annual returns. We're focused on, I think, providing investments that do provide those returns, and we can be kind of financially driven in that way. So I think, you know, a little bit gets into the alignment piece is why, for us, we don't do safes, and I think part of the reason there is we think it's we're not necessarily aligned well with entrepreneurs in a safe. And the one reason there is, like, there isn't a maturity date, right? And so I think it's almost like you're buying a warrant, right? You're buying an option, without the alignment to say, okay, we're going to actually make good on that investment in a certain period of time. So it's almost like, for us, the disadvantage of not having that maturity date is like, well, the entrepreneur, 3, 4, 5 years down the line, may not even have to have a discussion with us about how the company's doing if we give them a safe. And so I think, with a convertible note, at least, with a cap, with a maturity date, the kind of valuation cap, it mitigates some of that risk for us. And so, yeah, it's kind of where we stand. We do equity financings, we do convertible notes, those structures, but we do avoid safes.
Great. Okay, so we got a great spectrum here. And what I want to kind of start off now with is kind of like, let's just talk about some industry trends and dynamics. So we had some questions come in from the cohort, and basically there's a lot of sentiment of uncertainty in the world, especially from, at least in the US, the traditional funding sources of SBIR, STTR, even traditional grants that funnel research into industry. How do you guys see the industry responding to these new market dynamics? And as an investor, how do you see, or how does it change the way that you see companies in the space? Charles, maybe you could kick this one off for us.
Sure. Yeah. So, I mean, definitely, a lot has changed. Honestly, over the past, since COVID. It's a very different market than it was back then, and I think, um, you know, on from the investor standpoint, um, I think people are much more conservative today. And so, one a big change that I have seen maybe over the last year is looking for companies that have a reliable source of biopharma customers. So traditionally, when we think about the tools and diagnostic space, there's academic customers and there's biopharma customers. But with kind of a lot of funding constraints on the academic side, that market is more challenging. And so having, access to these biopharma customers and a reliable source of business there is becoming increasingly important. Um, the other thing that we look for, in general, I think it's no secret that uh, total number of deals and funding amounts are down across the tools and diagnostics industry. And so companies need to be capital efficient. We really need to focus on kind of what inflection points they're hitting and how they can get there on a minimal amount of capital to really, enable them to raise that next round of money, whether that's a commercial launch or, some number of quarters of recurring revenue. That needs to be very clear and well defined. And honestly, a lot of it just comes down to execution. We need companies that can execute kind of very well on, with leaner teams, with less capital in this more challenging market. And so I think all of that is just really forcing investors to take a really disciplined stance when evaluating companies in this space.
Great.
I'll
Sammy, how
jump.
about you guys?
Yeah, I'll
Yeah.
jump in. Obviously, times are changing. I think there's a lot of influx with academia, government funding to bring it back to the SBIR. But I do think that with that uncertainty, there's opportunity, right? There's more focus on sort of defense and biosecurity. So one of the things we like to see with companies that we invest in is did you go try to get non-dilutive funding? And there's there's philanthropy as well, right? There's definitely areas where you can augment, the dollars that you're getting, but also you need to be a little bit savvy about what's available, right? And so, okay, maybe there's less funding for NIH, but there's certain areas that if you look carefully, some of the dollars actually went up. So I think you have to think about being capital efficient, like Charles said, but you also got to, be be proactive, and I've talked to CEOs that said, hey, I have no desire to go get non-dilutive funding, and we've passed. Why? Because I don't think I mean, it's free money. Why not try to get it? And if you don't try, it shows me kind of a lack of effort, right? So there's a way to go there, and it doesn't have to be an SBIR. It could be through one of these other agencies, DARPA, ARPA-H. There's a lot of things that are sort of in flight, and I think those are different kinds of dollars that can really change the inflection for a company. And you go to investors and say, hey, you put in $1, I get you another $3 from the government, and we de-risk this, and we come out of the other end the prototype's done, and it's ready to go into pharma or academia, and it's a very different sort of opportunity. Keeps it tighter, more capital efficient, but it also, it's a little more sweat equity, right?
Interesting, but you don't see the angel investors aren't maybe swooping in to invest earlier to fill that gap with companies that maybe aren't as ready as they could have used to be based on the non-dilutive support.
I think it depends, right? If you ask me, I see people investing that have had exits, and there are a lot less exits. So yes, it seems that private equities moved earlier. I would expect venture capital to come in closer to the seed. A lot of them have these seed funds that they can deploy a couple of million at a time. So I do see things moving earlier, and I think that a lot of the angels are more cautious with their dollars. And then there's this big shift. At some point, we'll talk about it to AI, where funds are, AI and things are completely blowing up. So I think it just depends. In some cases, if you've got an AI angle, you're able to get lots of dollars. Whether you can monetize it and turn that around is a different question. You still, if you're making a drug, you still have to go through the FDA. So you need money to go down that path. And if you're a therapeutic, that's great. You may come in with less options that are, far more de-risked than 30 years ago. There are less people at the FDA doing their job, and so we still got to go through that. That's where the bottleneck is.
Thanks. Paul, do you have anything to add to this, or we could go to the next question?
No, I think you guys hit on a lot of the key points. So, yeah, I would just say like we probably look for three things, and when we make an investment, it's kind of like is there is there really defensible product and a value prop. I think our history is in IP, so we look at technologies. We like to make sure it's differentiated, and we kind of take the long road too, and think of like, all right, is somebody going to sue you? If so, are you going to be right? So we'll actually dig into the IP. Quite a bit. I think initially to figure out like what's there. So that defensible product. I mean, the second thing is, Charles talked a lot about this is capital efficiency and kind of understanding like you're running a business. Just think about it like, it's a roadside fruit stand, that you're responsible for those costs. It's not like you can get $10 million and then do what you want, right? So obviously, that's the mentality is just thinking about how do you run this thing profitably from day one.
Can I ask you to expand on that, Paul? And sorry to interrupt, but we
Sure.
talked about capital efficiency. I've heard it a couple times. When you say capital efficiency, what does that really mean to you? What when you look at a company, you say, "Oh, that company is capital efficient." Like, how do you what does that mean?
Yeah, so yeah, it probably means a couple things. Like one is like, you know, how much have they needed to raise to get to where they are today, right? It's like, if there's companies that have been able to take a product to market and have a couple million in revenue, raising like a million or less in money. And there's other companies that it's taken them 5 years and $30 million to do it, right? So, I think we tend to like the former company. Not there's, we know that like we understand that different products take different periods of time to get places, and some people are really shooting for the moon, right, in terms of their vision. But I think like, part of the capital efficiency question goes in line with like, look, are you really designing a product that, even after your 5 years of spending a bunch of money to get it there in R&D, are you sure, that it's going to really be a $20 million revenue product in 2 years or $100 million revenue product, right? And so I think it's tough to jump sometimes from academia where you're so excited about your project and your thesis to, okay, this could be a commercial product. Like that takes a lot of time and energy and talking to people and really, being honest with yourself about what's real and what's not. But I think the other side of it too is like managing costs, where we've seen a lot of companies, well, not a lot, but we've seen a few companies like have issues with RIFs, with reductions in force, right? Where the reason is because they've overhired marketing and sales right before they need that, right? So I think the way to think about, R&D, at least initially, is like, okay, what can you outsource, right? Can you outsource this engineering component, and save a lot of money that way versus hiring, FTEs? Can you really kind of compact, a single product into, your research, and then kind of figure out whether that's going to actually be marketable before you take on 3 or 4 pipeline products and you don't know if any of them are, and then you got a huge R&D staff, right? So I think having that in line initially is great, and then yeah, really only hiring a lot of salespeople when you're seeing that, holy crap, my one East Coast sales director is like working 60 hours a week. She really needs help here. We really need to hire because they're actually bringing in a lot of business, and they can't handle it. So we've seen people overhire initially, and then have to lay those people off, right? So that's really bad for everybody. So I think that's what I mean by capital efficiency, at least in
Yeah.
our case.
Yeah. Charles, anything to add to that on your side?
Yeah, I think Paul covered it really well. The only thing that I would maybe also add there is, one, I hear this mantra thrown around a lot when thinking about like fixed costs, things that are hard to cut down when the times get tight, is nobody ever went out of business for having too little lab space. So thinking about kind of those costs like real estate, things that you cannot get out of. And then the other thing is, to extend your runway with partnering, say you're a diagnostics company, or even a tools company, do you need to be the distributor for your products all over the world? Can you give ex-US rights or China rights to someone for some money early on and still have a sizable business? But now you've kind of, you don't need to hire that sales force. Someone else is taking that for you, and you're getting kind of an upfront payment for that, or some deal kind of along the way.
That's a great point. And actually, we have an upcoming webinar in a couple of weeks on sales and distribution. So stay tuned.
Perfect.
Um, so Sammy, I'd like to come back to you because you guys talked to the earliest stages of companies, I think, of the group here. And one of the questions we have is, how do you evaluate a company which, generates small revenues, maybe service revenues, proof of concept contracts, maybe some beta work in place? There's a little commercial traction, but not like a real commercial engine in place, or even long-term recurring contracts. So when you're thinking about investing in a company, let's say it's an equity deal so that we can like put a number on it, but how do you guys think about, or how do you negotiate in terms of like defining the value of that company for an investment at those types of stages?
Yeah, we would typically work with the company to, look at what return on investment could be, right? And that does take into account looking at comparables in the market and where an exit could be, and then you sort of work backwards. We tend to be, since we're early, we tend to look at companies that are sort of post-money valuation in that, sort of hopefully below 10 million. It depends on the opportunity. Obviously, if it's a therapeutic, it tends to be a little bit larger. But we tend to get involved early before those inflections happen, and we help guide them. So we definitely want to look at what the opportunity could be, right? If you tell me you're going to get 100x in a certain time frame, we have to validate that. And usually there's enough comps in the market If it's completely something new, we were investing in a company in the AI space, and it was early, so it's very hard to get our arms around that. And I think, there's a lot of information, but at the end, it boils down to what their comfort level is, and the investment that we're going to make, and whether we can come to terms together. Right? It's a conversation. Obviously, we'll come up with a term sheet. We'll do all of the legal side of that, but there's precedent for what those numbers are, and so we try to align on, okay, it's early, so we believe the share price should be this, and you have this many outstanding shares, so that's what your value is, right?
It reminds me of a story with my company, Sammy. I was raising my seed round on a safe, and it's one of those things, you're having a conversation with your first investor, and they're like, "Well, what is your valuation cap?" And I hadn't thought about it. I was like, it's just you have to make up something on the spot to act like you know what you're doing. And I was like, 15 million. And they were like, "Oh, okay." And I was like, "It sounds good." And I kind of kept that number for a while, but it wasn't getting me any closes. And finally, I had a conversation. A guy was kind enough to say, sounds a little high. And I'm like, "Well, why? It's just a valuation cap. It's not a real number. It's just it's
Yeah.
like the upside limiter." But they were like, I think five to six is like probably what feels right to me.
Yeah.
And I was like, "Oh, great." And then I went with that new number, and everything changed. But nobody told me, and I had, I should have asked, "Well, what do you think
Yeah.
it is?" instead of giving the number. But that's a great
We,
perspective.
yeah, one thing we tend to see is, there'll be a thought process around what the number is. Let's, for argument's say, it's eight, and then all of a sudden we're getting deeper in conversations, and we find some gaps in the diligence, and say, well, we believe if you did this, maybe it would be eight, but what about seven? And then you end up somewhere, maybe in the middle or closer to seven, if they're able to sort of bend a little bit. But at the end of the day, it really doesn't matter, because uh, it's always going to be about execution, what they can do for those dollars, and then get to the next inflection, and then hopefully the next raise, and then on their way to building a company of consequence, right? But it
Yeah.
does matter if you want 100x. I can tell you that, because you're not going to see 100x if the evaluation is too high, and the comps, companies are being sold for, 2 to 300 million, and the ones that IPO'd are way underwater, right? And that's kind of the environment we're in now.
Yeah.
So
Charles,
most
Paul.
most deals are coming back, and they're either flat rounds or they're down rounds.
Yeah, I'll
Yeah.
I'll add to that just one data point to put in everyone's mind. So SVB does a really great report a couple times a year on the healthcare market in general, but they cover tools and diagnostics. And I think from the 2024 year-end report, um, 75% of deals in the tools and diagnostics space were flat down or undisclosed, which is more than likely flat or down. So that to add a little oomph to Sammy's point there, kind of that is the market that we're in right now.
But there's some M&A, we
Mhm.
just heard about, obviously Olink, SomaLogic, Scale. There's some M&A, there's some
Yeah,
activity. I think things might be, hopefully picking up, but I don't know if they're great deals for the people in the company. It's always hard to tell. I mean, maybe Olink was, right? Because you're also generating a
yeah.
lot more revenue in later stage.
Mhm. Yeah,
Yeah.
you're certainly starting to see consolidation in some of these exciting places. Yeah, and how good those deals are certainly varies. But I write a letter every quarter covering some of the M&A activity, and I've had a lot more to write about over the last couple of months than I did a year or two ago. So,
Yep.
yeah.
So Charles, what we got you, and then we'll go to Paul. When you guys are looking at a deal, a little bit later stage, how do you guys think about these valuations in terms of your work? Is it based on revenues? Is it based on forward projections? What do you kind of think of there?
Yeah, I think evaluation is certainly an art and a science. There's a lot to it, but I would say like at its core, what it comes down to is comps, right? There's good data out there today that you can see where Especially at priced around Series A and later, like how much are people raising and what are these valuations at? So looking at, taking a broad lens of tools companies and maybe people's Series A's are priced in the, 10 to $25 million range, like ballparking there, to kind of get an idea of what's reasonable for you. And then, um, it's a negotiation there a little bit going back and forth. Um, as Sammy said, you got to keep in mind that all of your investors are trying to return some amount of capital, some multiple, and you know oftentimes tools investments don't have the same ceiling as therapeutics investments, and so working within their what valuation works for you while maintaining a potential for an exit at, if your comps are going for 2 to 300 million, allowing the, investor to get their money back at that point, also factoring in the kind of the future raises you have to do. So there's a lot that goes into it, but I think that the biggest factor is comps, comps for a similar series and comps for exits.
Gotcha. Okay. And Paul.
Yeah, yeah, I totally agree. I mean, comps drives a lot of it, right? It's hard to tell sometimes because in the tool space you have a lot of non-disclosed valuations, and you have a lot of private equity roll-ups, right? Of deals where things are kind of puttering along, and the company kind of needs to exit because their investors aren't going to or can't put any more money in. So yeah, you get to a point where like there's a skewed distribution, right? Where like there's a lot of deals that get done, probably honestly in like the 20 to 80 million dollar exit range that you just never hear about, right? So the ones that you do hear about are like bubble size or 80 million plus, and some high profile ones you see like, are a couple hundred million, but it's very few and far between. And like Charles said, the ceiling is lower, but also the buyer universe is lower for those types of big deals. Um, and so I think, when we think about valuation, yeah, it's coming at it as an LP. It's like, you know, we recognize that good performing funds, are going to do right 2x plus, right? And everybody says they're going to do 10x, but really, if you're a good VC fund, you're doing more than 2x return, right? There's a lot of funds that do less than 1x return, to their investors. There's a lot of funds that are in between that 1 and 2x, they're doing okay. Obviously, some funds, do 3 plus, but overall, it's like you can't always bank on that. And so we always come at it like, okay, how can we make sure that we're making 30% IRR or more, right? It's like, if we can only make 10 or 20%, year over year, we might as well invest in the S&P 500, right, as an LP.
Right.
And so we kind of really think about that. And so, just ensuring that an interesting way to think about that too is like, is your business growing at 30% year over year? It's like, it sounds too oversimplified, but that kind of gets you to something where, then we can say, all right, you know, this company is going to have a 3 plus X or ideally a 5X when we model it out return. And so for us, that looks like, look, it's hard for us to get comfortable with investing in an equity round where the valuation's above 20 million, just because we know that a lot of those exits do occur in that range of 20 to 80, right, in reality. And if we invest in 20 or 20 million plus in that range, we're going to put in downside protection into our notes and into our equity, right? Just as a matter of fact, and entrepreneurs shouldn't be frightened by that. I mean, the notion is like, if everything goes well as you say it will, then we don't need to use those downside protection mechanisms to gain some control, But at the end of the day, the alignment really is just around making sure that we can generate a return, for ourselves and for our investors, that's better than what we can do in the S&P 500.
Gotcha. All right, I'm gonna try to. We got 20 minutes left. This kind of running. We're going slower than I want to because there's a lot of questions to cover. So, Paul, I'm gonna punt this one to you. Um, for a company that's kind of raising their Series A, like a $10 million raise, they have some questions around how does a well scored SBIR affect your analysis of an investment decision? Does an SBIR, does a well-scored SBIR, does that validation, does that impact your investment criteria?
I mean, I think it's a bullet point. I would say having the funding in place is it would be better than just the score. I think I want some context in the score. I'd want to know like kind
Yeah.
of what the reviewer said and things like that. Um, I think it helps. I think recurring contracts, recurring revenue is better. But I think if it's the first raise, if it's pre-revenue for us, again, that's a little bit early. So it's probably less of a
Yeah.
regard in terms of the score versus funding in than maybe for
That's
other
the
investors.
second part of the question here is do you kind of have to have some form of revenue in place to sort of pursue a Series A? Is that kind of a requirement for you?
I think for us at this stage, for a tools investment or service investment, yeah, we'll still look at companies and we want to start conversations early. So I will say, like in our history, we've founded companies, we've seeded them, 10 plus years ago, but we don't really do that as much now, just because we have a stronger base of GPs who are providing that arm. So, but still we like to have conversations at any stage with companies because we understand that we can help them, and we can help them also down the line be good candidates for us to invest in when they do have that revenue.
Okay. Charles, do you have anything to add to that or a different perspective with Illumina?
Um, it'd be nice if every Series A company had revenue. I think, maybe short of revenue, it's good to have, some KOLs involved that are excited about your product, people who have tried it in their hands and can speak to it. I'm always going to want to talk to your customers or your early users. Um, and plan to launch pretty soon in that Series A, because I think, when I'm looking at this, I'm thinking about your Series B, and you're going to be hard pressed as a tools company to get Series B funding without several quarters of demonstrated growth and strong revenue. And so getting that done in the Series A, I would say, is a necessity. And if you can get it done earlier, that's great. The thing I would add is that thinking about that, maybe you don't have the revenue yet, but a lot of tools companies, especially the big guys, function by getting the majority, maybe 80% of their revenue from 20% of their customers. And so if you have those whale customers, large research institutes, whoever it is, kind of identified as early users, that's really powerful too. But those are the kind of signals that I'm looking for in the
Gotcha.
absence of revenue.
Okay.
Maybe I'll double
Sammy.
click on the SBIR angle.
Okay.
I think that, a fundable score is around 30. Obviously, it depends on the funding line. It depends on a lot of things that are, currently in flight. But if you got a 40, not an issue, right? Can you get that down? Is there one area that's missing, right? It might be the facility or the team, or it could be something that's solvable. And honestly, if you're getting a fundable score and it doesn't get funded, you're likely to move into the trajectory of being funded on the next round. The phase one is really, not going to change anybody's, sort of picture on the company, but it shows that it went through a process of peer review and people liked it. And phase two can change, right? You're talking a couple $1 million, and if you start to think about that for finishing out your product and building out the team, I think it's really helpful. And you're in this process. You don't want to become a company that just lives off SBIR. So that's the other extreme. You don't want to be you definitely want to find the KOLs. You want to align with whoever it is in pharma or academia that's going to buy the product and hopefully align. I like the 80/20. It's completely true. Most of the customers there are a few of them that they're repeat buyers, right? And they might be other companies as well. So you want to have a spread in that risk, because if something happens and all of a sudden academia is taken out of the equation, then you might have an issue, right? So I do see that process as being very valuable early, but you don't want to be relying on it. You want to basically sort of, go through this trajectory where eventually you can sell product. But there are companies that get bought pre-revenue. and you've made the product, you've got two choices, right? This is that valley of death where essentially you have to put enough instruments into the market so that the razor blade model can actually make sense. Well, that's going to take a lot of salespeople, commercial marketing, and that might take 10 years. And so by raising more money, putting that together, you might not be increasing the value for the company or the investors.
Hmm.
The company value will go up if you make sales. Now you have to manufacture more. So you're kind of moving a lot of things at the same time. And some people are great academic CEOs and founders, but they're not great salespeople and they're not great at building the company out in that direction. So it does depend.
Okay. I want to move over to kind of fundraising fundamentals. So, one of the questions we have is one of the biggest challenges I think for the founder is finding the lead investor, right? The one who's going to do the due diligence, who's going to write that first check and be the anchor for the deal. So, for you guys in the room here, what are like the top criteria to make you say, yes, I will lead a Series A deal? Um, or a seed deal there, Sammy. Um, what's your we can start at Paul and work down.
I'll jump in. For me, I want to make sure the idea is hopefully foundational and you've got IP. Whether it's issued doesn't matter. Maybe we have to look at some FTO, but really you're betting on the CEO, right? Really, that's the person you're saying you're going to drive this, uh, and I got your back, right? You can build out the team. There are lots of things you could also look at the track record. But a lot of times, these are first-time founders and you may like what they're showcasing and they may have some IP and it starts to feel like this could be something, big that can change and advance human health, change the needle on science. And so that's as an angel, you want to see that at a minimum. Uh, the expectation that you have a very, you know, strong financial model put together for something that's not been done before or something that's early is a little bit, questionable, but you want to see how they think and you want to understand, right? What's the market size, right? It's going to be a big market. Are you creating new market? Are you taking share from another customer? I think those are the things that are important. But for me, I would say this: it's great to have the patent. It's really great to have, the person that's going to build the company, and that's the person you're getting behind. Those are pretty important to me. They're fundamental.
Yeah,
Yeah, I just
Paul.
add, I totally agree with Sammy, and yeah, I mean, in terms of CEO and team, we look to make sure that we can work with this person, that we like this person. It's got to be somebody, right, who, you know, is flexible, but also can kind of manage up, right? And when I say manage up, I really mean like, how can you push an agenda along, get an investor or get somebody, you know, um, who's giving you money, excited about something that you guys might disagree on, right? So fundamental skill. It's really hard to establish that sometimes coming out of academia because in some cases, you know, you're you're in a hierarchy where the PI, if you're a grad student or a postdoc, kind of decides what to do and then you do it. And so, kind of when you get excited about something, managing up in a way, but also being flexible because there's so many unknowns. I think leaving your ego at the door, right, is a key thing. And a lot of entrepreneurs, figure that out as they kind of get older. And it's funny, like you'll talk to some CEOs who've had tons of experience exiting companies and they'll be in their 60s or whatever and you won't know the experience they've had because they're so modest and they don't come across but compare that to a first time CEO or founder. It's like there's some ego to be checked a little bit and you want to know that you can work with the person is a key thing. So we look for alignment and part of the reason there is like are you gonna fight your board, at early stages on kind of little issues, and I think you want the board to be aligned, especially when you're setting the what direction the ship is gonna go in. So, for example, if it's time for you as the CEO to move aside for another CEO to come in to scale the business, we got to know that you might be okay with that, right? And this, yeah, think about it kind of as your baby to take from conception to M&A is oftentimes doesn't actually pan out. In some cases it does, but oftentimes not. And I think being okay with, yeah, I might not be the right person for this job when this company starts to scale and get 5 or 10 million is important. I think the other thing that we've seen too is urgency, right? So a sense of urgency, right, when things go wrong is a tough thing if you're not already an executive to have, and knowing what signals to listen to above the noise and when to act on those, right, is really important. So kind of that comes in terms of personnel, right? So for example, if a particular salesperson or salespeople aren't performing, or you need to make changes, right? Making those changes and doing it quickly, and setting signals to your company that you want to grow this company fast. So I think that's a big part of it. Working with your scientific team as the executive to make sure you're aligned and ensure that the scientific team isn't pursuing a bunch of angles that are just really burning money on things that are not commercially viable, right? So I think those are some of the things we look for mainly. But again, as Sammy said, those financial projections, they have to be reasonable, but they're always going to be wrong. So
Wow. Thanks, but I feel like we just got a crash course in like being a great CEO. So that was great. Charles?
Yeah, I think a lot of it's been covered. I would just maybe a couple tangible things for the entrepreneurs. Ask the investors if they can lead. Look at who the partners are. If you ask me if I lead a therapeutics deal, I'm going to tell you no. And then if you have tools and diagnostics, yes. Um, Look at the partners. People like to lead deals in places that they know, and you want a lead that knows your space. So if they have a history of being an entrepreneur in your industry with similar companies, or they're invested on the board of not competitors, but similar companies, they're probably a good lead and they have the capability to do so if they say yes. So all the things they mentioned, but also ask and do some research. You can get a good sense from that as well.
Awesome. So in terms of these companies, I'm guessing you guys see probably not dozens, probably a couple hundred deals a year coming across your desk in some form. Um, and you don't make probably but a few investments, handful of investments a year. So in terms of the companies here, like what is it about the companies that stand out? What makes them cross that threshold, separate them from the competition? What can a company do to sort of be projected and be presented more of that, hey, let's really consider this deal as opposed to in the desk out the door or into the trash.
yeah, maybe I'll start. I'll be brief. I think, like, just like with dating or whatever, like, you don't want to seem desperate for funding, right? You want to project your value, and I think that's part of that is like having a polished deck, kind of understanding what to say when, and not like for example, saying we expect such and such valuation, or whatever. That's not going to fly. I think you know anticipating questions, right? Revising your deck, making sure that it's pretty solid, and you can kind of anticipate where things are going to go. Um, yeah, I think having a good sense of where you sit in the market is a really important one. Like we've kind of seen people think that their product is the best when just a little bit of research concludes, well, actually, there's a bunch of other products that are competing and could be better, and you probably should have addressed that in the conversation. And I think just being like flexible, in terms of timing, where every investor has a different timeline, and kind of trying to understand that process and ask questions about that, shows that you're professional and scholarly with how you think about, the fundraise.
Okay. Uh, Sammy, Charles, do you guys have anything to add?
I mean, we have a process that, involves fellows and you kind of graduate through that. And so the hope is that as that journey progresses, we get to get a flavor of, the responsiveness and a lot of the factors that Paul just mentioned. And again, it's hard to say, but we do filter and we want folks that didn't get through the gauntlet to keep in touch. And sometimes it's persistent. We had one company, I think, that applied 3 times, and we ended up selling to Thermo. So the third time was a charm, and it managed to, instead of just being a me too, showed, look, this is how it's going to win, and this is who's going to be the acquirer. And so through that journey that the homework was done, right? And took 3 times to make that story, and the third time, it got through, and at that third point, there was a patent. At that third point, it was very clear what the financial model would look like. So it just depends. We had a digital health deal come through, and completely different space, and it took us a lot longer to sort of wrap our arms around it. And I think it's going to be a big win for Life Science Angels. So there's a lot of opportunity, and I've seen deals where, hey, I'm going to come up with a cure for cancer, and you look at this and you say, okay, will that CEO be able to raise the 200 million to build out that therapeutic? And if the answer is yes, you can get behind it. If the answer is no, but we're okay to switch out. Like, you gotta have that feeling that, and a lot of times you gotta look at the cap table, right? Like, are these the right people? Are the right people incentivized? Do you have a bunch of academic co-founders that are, sort of, dead weight on the cap table? What is the company going to be sort of building, and who's going to be sort of, pushing that cart along the way is what matters, I think.
Great. All right. Well, we got just a few minutes left of the open session here, and I want to close on the hockey stick, the most famous part of the finance model. If you don't have a hockey stick, you're not going to get attention. But we were having a discussion kind of about, that financial growth curve that's a hockey stick. And Sammy, you had some comments I'd like to kind of start off with. Can you kind of tell us, what does that actually mean in terms of, like, how does the hockey stick relate to the company's growth trajectory and kind of maturity as a company?
Yeah, there's a transgression, and when you can basically position the company to grow, and that means you're adding sales, commercial. It's a different kind of company. If you can do those things, and increase the revenue, you can start to see that. It's hard. Usually takes longer than predicted. Uh, it's definitely one of those things that you put it in writing, and very quickly you realize that's wrong. But you adjust. Sometimes the customers will know what to do with the product, and they will come up with different workflows. A good example I think of is 10x Genomics, that they had a low price point. They got their customers to sort of build out their workflows, and they went in, from academia, they went into industry, and then this sort of organically grew. The price of the instruments increased. So you could start to see price of instruments increasing. You could start to see consumables increasing, and you can start to see that growth where now you're layering in not just one platform and the consumables and the reagents, but now you have a second platform. So you have to have a roadmap that sort of fits to it. Otherwise, the hockey stick on one sort of pipeline, it's generally not a hockey stick. It's generally, it's going to move, but it can't move by just adding more sales personnel and more marketing, because that's going to get dry pretty fast. You got to see it grow. And then that comes from having a very clear roadmap to lay out what's coming next, because they do layer on top of each other.
Well, and I think what's not obvious too is the infrastructure and the capital that goes into making that hockey stick happen, and the transition of the company from kind of an early product market fit to a sales growth engine. Those are very different companies. Paul, Charles, have you guys seen this done well or poorly in any of your companies? You don't have to name any names, but what are some things companies should think about when they're sort of, modeling out this hockey stick, but also preparing to sort of enter it, think about it?
Yeah,
Any advice?
very briefly, I've got two thoughts on this. I think VC is a lot about pattern matching. Um, and so if you can go out and talk to a lot of people and show me a company similar that maybe 5 years ago, like Sammy talked about 10x, for example, if you're building the next 10x, um, are you going to have faster adoption than them? Like get like realistic data on adoption rates from other companies that went before you and see if are you being adopted at 10 times the rate that they are? Because if so, that's probably not going to happen. And so being realistic and anchored to something there. And then the other thing is just, we've talked about this before, but also looking at other companies in terms of revenue, and it's a lot easier to capture 1% of $100 billion market than it is to capture 100% of a $1 billion market. And so how big is your market and what market share are you actually mapping to, and not kind of the Googling how big is the single cell market and giving me that number, but look at like 10x is 10K. How much revenue are they doing in single cell? They're most of the market. So take that, and that's a realistic top bound on the market. And so, is your $400 million revenue projection, which is the same as 10x's revenue last year, that sounds a lot like you're capturing 80-90% of the market. So anchor those points to things that are real and tangible, and that'll go a long way in making a really strong hockey stick model that's believable to me.
Awesome.
You guys
Paul?
hit all like such great points. I only have like one super minor thing to add, and I think it's really around like looking at the break even in the context of how much you're going to raise. So we've had one company as we looked at a couple of years ago where like they thought they needed 5 million. We took a look at their projections, their revenue projections, to break even. We took a look at the costs they need to get there. It said they probably need 15, and it turned out we were closer to being correct, and they ended up not being able to raise that much ultimately, but for an investor, you want to kind of really align on how much you're gonna have to actually spend to break even, in the context of what Charles and Sammy are talking about here. So just bearing in mind, the reality of getting a product to market and the market adoption rate, as you generate your financial model and in your fundraise ultimately.
All right. Well, thank you guys. Don't go anywhere, but that ends our live stream broadcast. So thanks for everybody tuning in.